Okay, let's start with a big question. What is the most brilliant, maybe the most sophisticated, non-Ponzi piece of financial engineering the world has seen to date? I mean, really something that fundamentally changes how we think about an asset class. Something almost paradoxical.
Yeah, that's the kind of question that gets financial engineers excited, really. And, for those of us really watching where digital assets meet corporate finance, there's one structure that, well, it really stands head and shoulders above the
You're
rest.
talking about Strategy Inc.'s STRC preferred stock.
Exactly. STRC. It's quite something.
It really is an incredible piece of design, isn't it? I mean, think about it. You take Bitcoin, an asset pretty much defined by wild volatility, right? Capable of huge drawdowns, like 80%.
Yeah, massive
And
swings.
the structure somehow transmutes that chaos, that volatility, into this steady, reliable stream of dividends. High yield, too, around 10.5%, and tax deferred.
Uh-huh. It's basically engineering stability right out of chaos. It's fascinating stuff.
And that transformation, that alchemy almost, is exactly why we're diving deep today.
Absolutely. And we've got a good set of materials to work with. We've gone through, a whole stack of sources, including the very latest quantitative data. Fresh off the presses, really.
Straight from Strategy Inc.'s Q3 2025 earnings call, the one that just happened yesterday.
That's the one released yesterday. So this lets us get past the marketing slogans and really dig into the legal and mathematical bones of this thing.
Okay, good. So our mission today, let's keep it laser focused. Two main things you really need to understand about STRC, things that often get mixed up.
Right.
First, we absolutely have to stress test that big claim from Michael Saylor. You hear it all the time. STRC is protected, it's guaranteed, even if Bitcoin tanks by a massive 80%.
It's a huge claim. We need to unpack what protected actually means in this context. Is it really like secured by collateral in the traditional sense, or is the protection coming from the financial structure itself?
Exactly, that distinction is crucial. And second,
Second, and this is maybe the most compelling part for a lot of our listeners, especially high earners, the tax deferred nature of those STRC dividends.
the return of capital, or ROC.
Precisely, ROC. We need to spend some real time on this because if you're salaried, maybe in a high tax bracket, the ability to push off significant tax liabilities.
Well, that's powerful.
Yeah, pushing that tax bill potentially way down the road, maybe into retirement or, maybe even into those uncertain times people worry about with AI and job security.
It's a huge potential benefit. We have to dissect how that works and, importantly, what the investor's responsibility is.
It's financial engineering design not just for today's market, but maybe for tomorrow's economy too. Okay, welcome everyone to the Deep Dive.
Great to be here.
And honestly, thank you. We're just blown away by the response this show keeps getting. The questions you send in, they really push us to dig even deeper into these sources.
They really do. And speaking of responses and gratitude, we had this interesting internal chat this week, kind of sparked by a factoid our team dug up. Oh, yeah. What was that?
Get this. Currently, only about 2% of our listeners are actually hitting the subscribe button.
2%. Wow. Okay. I mean, the listening numbers are fantastic. We love that. But yeah, 2% subscribing, it does make you think.
It sparked a bit of a debate, How can we serve this community better? How do we grow?
Right. And one thing that keeps coming up is video. We know visualizing these complex things like the capital waterfall we're about to get into, or how that adjusted cost basis works for taxes would be incredibly helpful.
Yeah, seeing it laid out visually makes a big difference. Our marketing folks are definitely pushing for video versions of these deep dives.
But here's the classic problem, right? The chicken and egg situation.
To do video well, especially for complex financial topics, you need the right tools. We're looking at some really advanced AI stuff, specifically something called the Mosaic AI video editor.
Mosaic AI, right? I've seen demos. It looks amazing. It can take our audio track and just automatically generate relevant B-roll, graphics, automate a huge chunk of the creative work.
It could be a game changer for visualizing this stuff, but
those tools cost money. And to unlock the funding we need for something like Mosaic AI, we have a specific target we need to hit. A subscriber threshold.
It's 1,000 subscribers. That's the number. That's sort of the structural financing hurdle for our show stepping up its game.
So look, we're just going to ask you directly. If you find this level of detailed analysis valuable, if you want to see us take this quantitative stuff and turn it into engaging videos you can easily share and refer back to.
But then please take a second right now and hit that subscribe button.
Yeah, please subscribe. And share this deep dive. Share it in your professional networks, your investment groups, wherever you discuss these kinds of things. Your support is genuinely the foundation. It helps us get the tools we need to make this content even better.
Help us engineer our own growth, so to speak.
Okay, let's do it. Let's jump right into the structure itself. Let's tackle that massive 80% claim head on. Okay, first things first. Let's unpack this central point of confusion. It trips up so many investors. You hear Strategy Inc.'s marketing right, and STRC sounds like it's backed by hard collateral, sometimes even 7 times over-collateralized.
Yeah, those phrases definitely suggest a traditional secured asset, like an ABS.
Exactly. But then you dig into the legal filings, the prospectus, and it states very clearly, unequivocally, that STRC is not collateralized. It's an unsecured obligation.
Right, polar opposites.
So how can both things be true at the same time? They seem completely contradictory.
They do seem contradictory, but they aren't, really. It's all about separating the strict legal definition from the economic reality and understanding Strategy's unique business model. Both statements are technically correct, but they're addressing different types of risk.
Okay, let's start with the legal side. The cold, hard legal truth. Why must the filing say STRC is unsecured?
Because in the world of finance law, collateralized or secured means something very specific. It implies a perfected security interest, a legal lien that's registered against a specific pool of assets.
So, like, if you have a mortgage, the bank has a lien on your specific house.
Exactly. And if the borrower defaults in this case, the holder of that secured interest, the debt holder or preferred shareholder, has the legal right to step in, seize those specific assets, and liquidate them to get their money back.
Okay.
The STRC prospectus makes it crystal clear. STRC holders do not have that right. There's no direct lien, no security interest against any particular Bitcoin holdings of Strategy Inc.
So, bottom line, if Strategy Inc. went bankrupt tomorrow, someone holding STRC couldn't just march into court and demand, say, the private keys to a wallet holding 100 Bitcoin to cover their investment.
Correct. That's not how it works legally. An STRC holder simply holds a preferred claim on the residual assets of the company as a whole. That's the legal status. It's an unsecured preferred equity position, albeit a senior one within the equity structure.
Okay, that's the legal reality, unsecured. Now let's switch to the economic reality. When Michael Saylor, or the company's marketing, talks about STRC being backed by hard collateral, what are they actually referring to?
They're talking about the nature of the company itself. Strategy Inc. calls itself a Bitcoin treasury company, and that's not just branding.
That's their whole business model.
It is. According to their own disclosures, their own risk factors, Bitcoin makes up the vast bulk of the company's assets. We just got the Q3 2025 numbers yesterday. We're talking 640,808 Bitcoin.
Wow. And at yesterday's prices.
Valued at roughly $71.61 billion. It's a massive single asset pool, and crucially, it's highly liquid.
So the backed by claim is really an economic statement, not a legal one. They're saying the company is essentially this giant pool of Bitcoin, and STRC has a high priority claim on that whole pool, even if they can't point to specific coins.
Precisely. The safety, or the perceived safety, of STRC doesn't come from a legal lien. It comes from two other pillars. First is asset coverage, just the sheer size and liquidity of that 640,000 plus Bitcoin pool relative to the company's liabilities.
Right. The mountain of Bitcoin.
Right. And second is structural seniority, where STRC sits in the capital waterfall, in the pecking order. It's high up, senior to a huge amount of junior equity beneath it. So yes, it's legally unsecured, but it's senior equity in a corporate treasury that's almost entirely composed of a highly liquid digital asset.
That makes sense. It's a different kind of security.
Yeah.
Okay, let's move on to what that 80% drawdown claim actually covers. The source material called it a two-sided coin of protection. What are the two sides?
Yeah, Saylor's big claim actually addresses two distinct fears investors might have. First, the fear of losing your original investment, your principal, and second, the fear of the company missing a dividend payment.
Okay, let's take the first one, principal security. The liquidation failsafe. This is the catastrophic scenario, right? Bitcoin crashes, the company potentially dissolves.
This is the scenario we're going to stress test quantitatively in the next section. The claim here is purely mathematical, it says. Even if Bitcoin collapses by 80% and the company is somehow forced into liquidation, the remaining value of those Bitcoin assets is still enough to pay off all the senior debt and fully redeem every dollar of STRC principal at its liquidation preference, which is usually par value.
And the protection comes from?
It comes from the quantitative cushion. The layers of capital below STRC in the waterfall, the junior preferreds, and the common stock absorb the losses first.
Okay, that's principal safety in a meltdown. What's the second side? dividend security. This is about solvency, right? The ongoing ability to actually pay that 10.5% yield quarter after quarter.
This one's actually trickier, and this is where the financial engineering gets really interesting and maybe, a bit riskier too.
How so?
Well, think about the numbers. The company has this massive fixed annual preferred dividend liability across all its preferred stock tranches, STRC, STRF, etc. We're estimating it's around $640 million per year.
$640 million in fixed payments every year.
Okay. Now look at their cash position from the Q3 report. Operational cash on hand. Just $54.3 million.
Wait, $54 million?
Yeah.
Compared to $640 million due annually, that sounds incredibly low. That's barely enough cash for a month's worth of those obligations, maybe.
It's a significant liquidity mismatch, a very low operational cash balance relative to the fixed payout requirements. And that critically low cash level is precisely why the credit rating agencies, like S&P Global, have assigned Strategy Inc. a B rating.
Junk status.
Junk status. And they state pretty clearly it's driven primarily by liquidity concerns, not necessarily the quality of the underlying asset, the Bitcoin.
Okay, so if they only have $54 million in cash, how on earth do they pay that $640 million annual dividend bill? Especially if Bitcoin has crashed 80% and the company's already under financial pressure.
This is the core of the engineering. It's what we call the circular funding model. The company's stated policy, it's practically enshrined in their governance, is to avoid selling Bitcoin almost at all costs, the never sell philosophy.
Right, the HODL strategy at the corporate level.
Exactly. So to meet that $640 million liability, the dividends plus any debt interest, they don't sell BTC. Instead, they maintain solvency by constantly tapping the capital markets.
How?
Specifically, the policy is to tactically issue common equity using at-the-market or ATM programs.
Okay, so they're basically printing new shares of their common stock, MSTR, selling those shares to institutional buyers or just into the open market, raising cash that way?
Yep.
And then using that freshly raised cash to pay the interest on their debt and the dividends on their preferred stock, like STRC.
That's the loop. That's the circular funding model, and this is why the 80% drawdown claim is so critical for dividend security, too.
How does that connect?
Because our stress test, which we'll detail next, confirms that even after Bitcoin crashes 80%, the company still has significant positive net equity value remaining. About $6.08 billion based on Q3 numbers.
So it's still technically solvent.
Exactly. Because it remains solvent, the common stock, MSTR, even though its price would be hammered, still theoretically possesses some non-zero value. And that solvency, that remaining equity cushion, is the lifeline. It's what allows the company to argue that it can continue to issue MSTR stock via the ATM program and raise the cash needed for dividends, avoiding a forced Bitcoin sale.
Okay, so the dividend security isn't guaranteed by cash reserves. It hinges entirely on the market's ongoing willingness to buy newly issued MSTR stock.
That's the crux of it.
Even during a crypto winter, even if Bitcoin is down 80%, even if the company looks financially stressed.
Yes. The whole system relies on continuous access to the equity capital markets.
What happens if those markets seize up? Or if investors just lose confidence entirely and say, nope, we're not buying any more MSTR stock at any price?
That is the core structural risk. It's exactly what S&P pointed to with the B rating. If there's a broader systemic crisis, maybe a deep recession that shuts down equity markets, or if investors decide that remaining $6 billion equity cushion is essentially worthless in a panic.
Then the ATM model breaks down instantly.
Instantly. The funding source dries up. At that point, the dividend security is impaired, the company faces default on its obligations, or it's forced to break the never sell rule and liquidate Bitcoin as a last resort.
So just to summarize this section, the 80% claim seems to provide strong mathematical backing for principal protection in a liquidation scenario.
Correct. Based on asset coverage and seniority.
But the dividend protection, while linked to solvency at 80% down, is ultimately only as strong as the equity market's continuous belief in and funding of the circular treasury model.
It's an elegant structure, definitely clever, but it's inherently high stakes. It's built entirely on the assumption of ongoing market access and solvency. It swaps direct asset risk for market access risk, you could say.
An extraordinary use of structural priority, but with that perpetual reliance on equity issuance. Okay, let's see the numbers that back up the principal protection claim. All right, let's get quantitative. We need to move beyond just saying structural seniority and actually build the liquidation waterfall. This is the nitty-gritty mechanism that supposedly guarantees STRC's principal in that 80% crash scenario.
Exactly. Laying out the waterfall shows precisely who takes the hit first, second, third, and who's protected by the layers below them. We have to start with the total value of the assets available for liquidation.
Okay, using the Q3 2025 data released yesterday.
Yep. Holdings. 640,808 Bitcoin. For our baseline, let's use a recent price, say $111,748 per Bitcoin.
Okay, 640,808 times $111,748.
That gives us a total liquidatable asset value of $71.61 billion. That's the whole pie we're dividing up in a potential liquidation.
71 billion. Okay, that's the pool. Now, who gets paid first? Tier 1, the absolute top priority.
Tier 1, senior debt claims. These are the company's convertible notes. They have the highest legal priority, absolutely must be paid in full before anyone else gets anything.
And how much is that?
The total claim for the senior debt is $8.24 billion. So that's our first hurdle. Cumulative claim so far, $8.24 billion.
Got it. $8.24 billion off the top for the debt holders. Next up, Tier 2, the preferred equity. But these aren't all equal, right? There's seniority within the preferreds.
Correct. They are tiered. The most senior preferred stock tranche is STRF.
STRF. Okay, how much is its claim?
STRF has a notional value or liquidation preference of $1.26 billion, so we add that to the debt.
$8.24 billion plus $1.26 billion.
Brings the cumulative claim needed to cover both debt and STRF to $9.50 billion.
Okay, nearly $10 billion needed to cover debt and the most senior preferred. Now, where does STRC, the one we're focused on, fit in?
STRC comes next. Tier 2B, STRC, the fail-safe security, as we're calling it, its liquidation preference is $2.80 billion.
$2.8 billion.
Okay, so we add that $2.80 billion to the $9.50 billion cumulative claim from above.
$9.50 plus $2.80. That's $12.3 billion.
$12.30 billion. That's the key number for STRC. It means STRC is 100% protected, paid in full, as long as the total value of the assets doesn't drop below $12.30 billion.
$12.3 billion. Got it. Are there more preferreds below STRC?
Yes. These are the structural shock absorbers, the cushions. Tier 2C, STRK, and STRD. These are junior preferred tranches.
Okay, the junior preferreds, how much is their claim?
Together, STRK and STRD have a total claim of $2.64 billion. This layer exists specifically to absorb losses before STRC gets hit.
So adding that $2.64 billion.
Takes the total cumulative claim, covering all debt and all preferred equity, up to $14.94 billion.
$14.94 billion.
Okay.
And below that?
Below that is Tier 3, common equity. The MSTR common stockholders, they are the residual claimants. They get whatever, if anything, is left after that $14.94 billion is paid out.
Okay, the waterfall structure is clear now. Debt first, then STRF, then STRC, then the junior preferreds, STRK, STRD, and finally MSTR common stock gets the leftovers. STRC is protected by that $2.64 billion layer of junior preferreds plus all the value of the common equity below that.
Exactly. That's the structural protection.
Now for the critical test. Let's simulate that 80% Bitcoin drawdown scenario using these Q3 numbers. Prove the claim.
Right. Our baseline BTC price was $111,748, and 80% crash from that level gives us a post-crash Bitcoin price of $22,350 per Bitcoin.
$22,350. Ouch.
Yeah. At that low price, the value of the 640,808 BTC holdings plummets. The total liquidatable assets shrink dramatically from $71 billion down to $14.32 billion.
Okay, $14.32 billion is the size of the pie in this crisis scenario.
Yeah.
Now let's run it through the waterfall we just built, step by step.
Step 1. Pay the Tier 1 senior debt. The claim is $8.24 billion. Do we have enough?
We have $14.32 billion, so debt gets paid in full.
100% recovery for Tier 1 debt holders. That leaves $14.32 billion minus $8.24 billion, which is $6.08 billion remaining in the pool.
$6.08 billion left. Okay, step 2. Pay the most senior preferred, STRF. Their claim is $1.26 billion.
We have $6.08 billion. So yes, STRF is also paid in full, 100% recovery for STRF.
Okay, $6.08 billion minus $1.26 billion leaves $4.82 billion.
$4.82 billion remaining. Now, step 3, the moment of truth for STRC. Its claim is $2.80 billion. Do we have enough?
We have $4.82 billion left. Yes, easily covers the $2.8 billion.
STRC is paid in full. 100% recovery for STRC principal. The claim is fully satisfied. The 80% drawdown protection holds.
Mathematically validated using the latest numbers. Okay. And crucially, how much is left after paying STRC?
$4.82 billion minus the $2.8 billion for STRC leaves $2.02 billion remaining in the pool.
$2 billion still left over even after an 80% crash and paying off all debt, STRF and STRC. That's the buffer.
That's the buffer, and it highlights why those junior preferred tranches, STRK and STRD, exist.
Right, let's pause on that. Why did Strategy Inc. even bother creating those junior preferreds? Why not just have debt, STRC, and common stock?
Because they act as that dedicated visible cushion. Their entire purpose is to be the first equity layer to absorb losses below STRC but above the common stock. For institutional investors considering buying STRC, and certainly for any rating agency looking at it, seeing that specific $2.64 billion tranche explicitly designed to take losses first provides significant comfort.
It makes the seniority claim of STRC more credible.
Exactly. It makes the 80% drawdown claim much more robust and believable. It's a dedicated buffer zone.
Okay, so in our 80% crash scenario, where does that remaining $2.02 billion go?
It goes towards satisfying the claims of the junior preferreds, STRK and STRD. Their total claim was $2.64 billion.
So there's only $2.02 billion left.
Correct. So the junior capital absorbs the remaining loss. STRK and STRD holders receive $2.02 billion against their $2.64 billion claim. They get about 76.5% of their principal back, suffering a loss of roughly 23.5%.
And the common stockholders, MSTR.
They get nothing. The $2.02 billion runs out before reaching them. MSTR is completely wiped out in this scenario. They absorb the final, most severe part of the loss.
The tranching really works. It isolates and directs the risk. Okay, now that we have this model, let's refine the risk threshold. Saylor often says 80%. But where does STRC principal actually start to get impaired? What's the true break-in point?
We can calculate that precisely. STRC principal starts taking a hit the very moment the total asset value dips below the cumulative claims of everything senior to it and including itself.
Which we calculated earlier was
$12.30 billion. That's the threshold. If assets fall below $12.30 billion, STRC doesn't get its full $2.80 billion back.
Okay, so $12.30 billion is the minimum asset value needed. How do we translate that back into a Bitcoin price?
We just divide that minimum asset value by the number of Bitcoin holdings. So $12.30 billion divided by 640,808 Bitcoin.
Okay, punching that in. 12,300,640,808 comes out to roughly $19,200 per Bitcoin.
$19,200. That's a break-even BTC price of STRC principal. If Bitcoin falls below $19,200, what percentage drawdown is that? Let's see. 111,748 line $19,200. 111,748%. It's about 82.8%.
82.8%. So the actual structural protection for STRC principal is even better than the commonly quoted 80% figure. It extends almost 3 percentage points lower.
That's right. The 80% claim is actually a slightly conservative buffer. The true impairment point is closer to 83% down.
That's impressive. Okay, one more threshold just for context. The absolute bottom, total corporate insolvency, the point where even the senior debt holders start losing money.
That happens when the total asset value fails to cover the senior debt claim, which is $8.24 billion.
Okay, $8.24 billion divided by 640,808 Bitcoin.
That gives a BTC price of $12,859 per Bitcoin.
$12,859.
Right. And that corresponds to a drawdown from our baseline of 88.5%.
88.5%. So any claims you might hear about the structure being safe down to, say, a 90% crash are quantitatively incorrect. The debt holders themselves would already be taking losses at that point.
Correct. The absolute insolvency point where the whole structure fails, even the top tier, is around an 88.5% drawdown.
Okay, this waterfall analysis is powerful. But now let's circle back to that crucial point we discussed earlier. The never sell strategy versus the reality of needing cash. What happens if, in that 80% crash scenario, the circular funding model fails? They try to issue MSTR stock, but the market says no.
This is the ultimate stress point, beyond just the asset value calculation. If they can't raise cash by issuing equity, they must find the money for dividends and debt interest somewhere. And the company's own SEC filings, the risk disclosures, are very clear about the last failsafe.
Which is?
The forced sale of Bitcoin. It's explicitly stated. If other financing avenues fail, the company is obligated to sell BTC to meet its senior obligations, like the preferred dividends.
And this triggers that massive hidden risk we touched on earlier.
Exactly. The potential for a taxable death spiral. Because remember, Strategy Inc. bought its Bitcoin over time at various prices. Their average cost basis per coin is quite high. Let's use the Q3 number, $74,032 per Bitcoin.
$74,000 average cost.
Now, in our 80% crash scenario, the market price is down to $22,350. If they are forced to sell Bitcoin at $22,350 to raise cash for a dividend payment,
They instantly realize a huge loss for tax purposes on every single coin sold.
Yeah.
$74,032 cost basis minus $22,350 sale price.
That's a $51,682 capital loss realized per Bitcoin sold. It's enormous. And to raise the, say, $640 million needed annually for dividends and interest, they'd have to sell a significant number of Bitcoin at these depressed prices.
Instantly crystallizing potentially billions in realized tax losses on their books.
Yes, and those realized losses hammer the company's remaining equity value. That $6.08 billion equity cushion we calculated in the 80% stress test starts evaporating much faster.
Which makes it even harder to issue MSTR stock in the future because the equity base is shrinking.
Exactly. It creates a negative feedback loop. Selling BTC at a loss erodes equity, making equity issuance harder and more dilutive, potentially forcing more BTC sales, further eroding equity. It's a potential spiral.
And that's why the entire structure, the circular funding model, the focus on solvency, is all engineered with such complexity to avoid triggering that forced sale and the resulting tax nightmare at all costs.
It's the linchpin risk underlying the whole dividend payment mechanism.
Okay, we've thoroughly stress-tested the principal protection and explored the risks around the dividend payments. Now, let's shift focus to the other major pillar of STRC's appeal, especially for high-income earners, the tax deferral.
The return of capital. ROC.
But first, quickly, that recent dividend increase. For November 2025, the rate ticked up to 10.5%. Some people might see that and think, oh, are they desperate? Are they trying to prop up the price? Is that what's happening?
No, not at all. Actually, it's the opposite. It's a sign that the structure is working exactly as designed. It's purely mechanical stability engineering in action.
Mechanical.
Yeah.
How so?
STRC is a variable rate preferred stock. That means the dividend rate isn't fixed forever. It adjusts based on preset rules tied to the stock's trading price. The entire purpose of these rules is to actively manage the price, to sort of strip away short-term volatility and keep the share price trading close to its $100 par value.
So the rate adjusts automatically to stabilize the price.
Precisely. And the Q3 trading data shows exactly why the rate went up. STRC had recently dipped slightly below par, trading in the range of, say, $95 to $98.99.
Yeah.
The prospectus contains specific rules for this. If the stock trades consistently in that slightly below par range for a certain period, it automatically triggers a pre-programmed increase in the coupon rate. In this case, it triggered a 25 basis point hike.
So the increase from 10.25% to 10.50% wasn't a discretionary decision by management.
Nope. It was the automated mechanism firing as intended. It's designed to counteract those mild price dips by making the yield slightly more attractive, thus pulling the price back towards $100. It's a feature, a stabilizer, not a sign of weakness or desperation.
Got it. Okay, that makes sense. Now, on to the main event for this section. The tax treatment. Why are these dividend distributions classified as tax-deferred return of capital, ROC? This concept is powerful, but often really misunderstood.
It is powerful. Let's break it down. When a distribution is classified as ROC, it means that for tax purposes, the IRS doesn't view it as income or profit being paid out by the company.
Okay, so it's not like getting a regular dividend from, say, Apple or Microsoft, which is generally taxable income in the year you receive it.
Exactly. Instead, ROC is treated as the company returning a portion of your own original investment principal back to you.
And the immediate tax benefit of that classification is?
The big one. You are generally not taxed immediately on that cash distribution in the year you receive it. You get the cash flow, maybe 10.5% annually, but you don't declare that specific cash receipt as current income on your tax return.
So no immediate tax hit. Where does the tax eventually come in?
It's deferred. Instead of paying tax now, the ROC amount you receive reduces your adjusted cost basis in the STRC shares you own.
Adjusted cost basis. Okay, let's make that concrete. If I buy STRC for $100 a share, and I receive $10 in ROC distributions over the year.
Your adjusted cost basis for that share is no longer $100. It's now $90. $100 original cost minus $10 ROC received.
And the tax consequence comes later when I eventually sell the share.
That's right. When you sell, your capital gain or loss is calculated based on the difference between your selling price and that lower adjusted cost basis. So in effect, you're converting what might have been ordinary income today into a potentially larger capital gain years down the road.
Which is usually taxed at lower long-term capital gains rates, plus you've had the use of that deferred tax money all along.
Exactly. It's the time value of money working for you on your tax liability. It can be a significant benefit, especially compounded over many years.
Okay, so why can Strategy Inc. classify these payments as ROC? What's the underlying mechanism? It seems almost too good to be true.
It hinges entirely on a crucial concept in U.S. tax law, earnings and profits, or E&P.
E&P, not the same as regular accounting profit, right?
Definitely not. E&P is a specific tax accounting measure. Under the tax code, a cash distribution from a company can only be classified as a taxable dividend if the company has positive cumulative E&P.
Okay, positive E&P means taxable dividend. What if E&P is 0 or negative?
If the company has 0 or negative E&P for tax purposes, then any cash distribution it makes is automatically classified, first as a non-taxable return of capital up to your basis, and then potentially as a capital gain after your basis hits 0.
And Strategy Inc.
Strategy Inc. currently has negative tax E&P, and crucially, based on their business model and projections, they expect this negative E&P status to continue for potentially 10 years or more.
10 years or more of ROC distributions. How is that possible, especially when their regular financial statements sometimes show billions in net income, like they did in Q3 2025 due to Bitcoin's price jump?
This is where the distinction between GAAP accounting, the financial statements, and tax accounting for the IRS is absolutely critical. That $2.8 billion net income reported under GAAP rules was mostly an unrealized gain. It reflects the increase in the market value of their Bitcoin holdings under the new fair value accounting standards.
But unrealized gains aren't taxable income.
Exactly. For tax purposes, which determines E&P gains or losses are generally not realized until the underlying asset is actually sold.
And Strategy Inc.'s core strategy is never sell.
Precisely. By sticking rigidly to acquiring and holding Bitcoin and avoiding sales, Strategy Inc. deliberately avoids realizing those potentially massive embedded capital gains for tax purposes.
So even if Bitcoin goes to the moon on paper, their taxable income remains low or negative because they haven't sold anything.
Correct. This keeps their cumulative tax E&T negative, and that is the engine that allows them to classify the cash distributions they make cash, which, remember, they raise by issuing MSTR stock, not from operational profits, as non-taxable ROC for their recipients.
Wow, okay. That is genuinely brilliant structural tax engineering. They use cash raised from the capital markets, selling MSTR stock, to fund the STRC dividend payments. But because the source of that cash is technically new capital coming into the entity, and because the entity itself has no positive taxable E&P, the outflowing cash distribution gets treated as a return of the investor's capital.
That's the logic. It's quite sophisticated.
However, and this is a big however, this fantastic tax treatment comes with a catch. It places a really important non-negotiable administrative burden squarely on the shoulders of the investor. Right? This might be the single most critical takeaway for anyone holding or considering STRC.
Absolutely critical. It is non-negotiable. The tax reporting process here has two parts, and the second part is entirely 100% your responsibility as the investor.
Okay, let's break down the two parts. Part one is the easy part, what your broker does.
Right. Your brokerage firm will send you a Form 1099 DIV at the end of the tax year.
Like for any stock dividend.
Yes, but the key is where they report the STRC distributions. Because they are ROC, they will report the total amount you received during the year correctly in Box 3, non-dividend distributions.
Box 3, non-dividend distributions.
Your tax software, like TurboTax or whatever you use, is programmed to read Box 3. It sees that amount and correctly excludes it from your current year's taxable income calculation. So far, so good. That part is automated.
Okay, that's the easy bit. Now the hard part. The crucial part that falls on the individual investor.
This is it. You, personally, are legally responsible for meticulously tracking and adjusting your adjusted cost basis for every single share of STRC you own.
So every time I receive an ROC distribution reported in Box 3,
you must manually subtract that dollar amount from the original purchase price you paid for those shares. If you bought at $100 and get $10 in ROC, your new basis is $90. If you get another $5 next year, your basis drops to $85. You have to keep a running tally for as long as you hold the shares.
why is this manual tracking so incredibly important?
Yeah.
What happens if someone just doesn't bother? If they just report their original purchase price when they eventually sell?
Ignoring it is effectively tax misreporting and potentially tax evasion if done knowingly. Let's run that example again to show the danger clearly.
Okay. Buy STRC at $90 per share.
Hold it for, say, 5 years. Over those 5 years, you receive a total of $20 per share in ROC distributions, all reported in Box 3 each year and correctly excluded from your income at the time.
So my adjusted cost basis should now be $90 minus $20, which equals $70 per share.
Correct. $70 is your legally accurate basis. Now, let's say you sell the share for $95.
Okay, sell at $95.
If you haven't tracked your basis adjustments, you might mistakenly think your basis is still the original $90 you paid. So you'd report a capital gain of $5 per share, $95 sale price, $90 original basis.
Seems simple enough if you forget the ROC.
But it's wrong. The IRS knows via the 1099 DIVs your broker filed each year that you received $20 in non-taxable ROC distributions over the holding period. They expect your adjusted basis to be $70. Therefore, your actual legally reportable taxable capital gain is not $5. It's $25 per share, $95 sale price, minus the $70 adjusted basis. By reporting only a $5 gain, you have failed to report the tax liability on that $20 of income that was deferred via the ROC mechanism.
And the IRS has the data from the brokers to easily spot that discrepancy.
Absolutely. They have the Box 3 data reported by the broker for the distributions, and eventually they get the sale price reported on Form 1099-B. If the reported capital gain doesn't match the expected gain based on the known ROC distributions, that's a huge red flag. It screams, audit me, especially for high-income individuals who are more likely to hold such securities.
So the ROC treatment isn't tax avoidance, it's tax deferral. You absolutely will pay tax on that income eventually when you sell. You just need to make sure you report the correct, larger capital gain at that time by accurately tracking your basis adjustments.
That is the deal. It's a massive benefit, getting the cash flow now, deferring the tax, potentially getting lower capital gains rates later, but it comes with this unavoidable administrative string attached. You must track your basis. Your accountant can help, but the ultimate responsibility is yours.
Crucial advice. Okay, let's move to the final section. How does engineering the stability for STRC impact the rest of the capital structure, particularly the MSTR common stock?
Where we've spent a lot of time talking about the stability engineered into STRC. You know, the high yield, the tax deferral, the structural protection against drawdowns. It sounds great for STRC holders.
It does.
But, in finance, there's rarely a free lunch. Stability usually comes from somewhere. Risk doesn't just disappear, it gets redistributed. So if STRC is made stable, where did Strategy Inc. put the risk? Where did the volatility go?
That's exactly the right question. And the answer is they placed it squarely onto the common stock, MSTR. This is the final, really clever layer of the financial engineering here. The deliberate tranching of risk.
Tranching again, dividing up the risk pie. By creating these senior tranches like STRC and STRF that demand stability, high priority in liquidation, and a steady yield, Strategy Inc. intentionally created a junior tranche, the MSTR common stock, that ends up holding the pure, unadulterated, and actually amplified exposure to Bitcoin's volatility.
How does STRC's stability amplify MSTR's volatility?
Because of that structural priority we keep talking about, STRC has a senior claim. It gets paid first in liquidation after debt. It has a high priority claim on cash flow for its dividends. That priority acts like a shield for STRC, but it simultaneously acts as a lever on the layer below it. It transfers the burden of the underlying asset's volatility, the swings in Bitcoin's price, away from the preferred shareholders and concentrates it, magnifies it even, onto the MSTR common stockholders who are last in line.
So it's not just that MSTR is risky because Bitcoin is risky. The structure itself makes MSTR even more volatile than just holding Bitcoin directly.
In many ways, yes. It's by design. MSTR isn't meant to be just a simple proxy for owning Bitcoin. It's engineered to be a structurally leveraged vehicle. And that's precisely why you often hear people describe MSTR common stock as being like a leveraged call option on Bitcoin.
Okay, the call option analogy. Let's break that down carefully for everyone. What does that mean in practical terms?
Sure. Let's think about a standard call option in the markets. If you buy a call option, say, on Bitcoin, you pay a small premium for the right, but not the obligation to buy Bitcoin at a specific fixed price, the strike price, sometime in the future.
Right. And if Bitcoin's price shoots way up above that strike price, your option becomes very valuable, giving you leveraged gains compared to just buying the Bitcoin outright initially.
Exactly. Huge upside leverage. Now, let's map Strategy Inc.'s capital structure onto that call option framework. It fits surprisingly well.
Okay, what's the underlying asset in this analogy?
That's the easy part. It's Strategy Inc.'s massive holdings. The 640,808 Bitcoin. That's the asset whose performance drives everything.
Got it. Now, the crucial part, what represents the strike price? of this structural option.
The strike price here isn't a price to buy Bitcoin. Instead, it represents the total fixed, non-negotiable annual cost or obligation that the company must pay out before the MSTR common stockholders get anything at all from the company's value or cash flow.
And that fixed obligation includes.
It includes the interest payments on their debt, but the biggest, most dominant piece is the massive preferred dividend liability.
That $640 million per year we estimated earlier, owed mostly to STRC, STRF, and the other preferreds.
Correct. That entire $640 million fixed annual payout acts like the structural strike price. The value generated by the Bitcoin assets has to overcome that fixed hurdle every single year before any residual value accrues to the MSTR holders.
Okay, so Bitcoin is the underlying asset. The $640 million in fixed payments is the strike price. And the MSTR stock itself.
The MSTR stock is the call option in this analogy. The MSTR stockholders are the most junior claimants, the residual owners. They only get what's left over the upside potential after that huge, fixed $640 million annual strike price has been fully paid off.
Okay, the analogy makes sense. Now let's see how this plays out. Explain the leverage effect. First, the scenario everyone loves, good times. Bitcoin soars, maybe well above our $111,748 baseline.
Right. As Bitcoin's price climbs, the total value of Strategy's Bitcoin treasury balloons may be into the hundreds of billions. Meanwhile, that $640 million annual dividend and interest payment owed to the senior capital tranches
Remains absolutely fixed. It doesn't go up just because Bitcoin went up.
Exactly. That $640 million fixed cost becomes increasingly trivial, almost insignificant, relative to the massively swelling asset value. And because MSTR shareholders are last in line, the residual claimants they get to capture essentially 100% of that enormous remaining upside value after the fixed costs are paid.
So their gains are magnified, potentially far exceeding the percentage gain of Bitcoin itself during that period.
Massively magnified. It behaves exactly like a deep in-the-money call option. The fixed strike price, the $640 her payment, has been easily cleared, and the option holder, MSTR shareholder, is capturing almost all the subsequent gains on the underlying asset.
Okay, that's the upside leverage. Now the dangerous side, the bad time scenario. Bitcoin falls significantly, say, back down to $50,000 or lower.
The total value of the company's Bitcoin assets shrinks rapidly, but that $640 million annual obligation owed to STRC, STRF, and the debt holders
Still remains fixed at $640 million per year. It does not decrease just because Bitcoin fell.
Correct. And now that large, constant, non-negotiable fixed cost starts consuming a much larger percentage of the shrinking asset value. It eats away at the remaining equity much more aggressively.
And who bears the brunt of that?
The MSTR holders. As the residual claimants, they are the first ones to feel the pain of that fixed cost burden on a shrinking asset base. Their losses are magnified, potentially far exceeding the percentage loss of Bitcoin itself.
It behaves like an out-of-the-money call option, where the fixed strike price is looming large relative to the underlying asset's value, rapidly eroding the option's value towards zero.
Precisely. The fixed nature of the senior claims creates downside leverage just as effectively as it creates upside leverage.
So fascinatingly, the very mechanism that provides the stability and reliable income stream for STRC, its high priority claim and its fixed or predictably variable dividend rate, is the exact same mechanism that transforms the MSTR common stock into this highly volatile, leveraged bet on Bitcoin's price.
It's a zero-sum game of risk distribution across the capital stack, executed through brilliant, if complex, financial engineering. Creating this stable, yield-producing STRC wasn't just a benefit for preferred investors. It was arguably a necessary structural step to turn MSTR into the supercharged, high-volatility vehicle that many of its common stockholders are actually seeking.
Really does redefine how you can use corporate structure to slice and dice the risk profile of a single underlying asset, creating entirely different investment propositions from the same pool of Bitcoin.
And it's a powerful reminder, isn't it? Stability in finance is rarely just found lying around. It usually has to be actively engineered. And often, that engineering involves concentrating the instability somewhere else in the system.
A profound point.
Yeah.
Okay, that brings us near the end of our deep dive into STRC's security and tax engineering. I hope breaking down the waterfall and the ROC mechanics really helps clarify how these bold claims are made and what the real risks and responsibilities are.
It's complex, but hopefully laying it out step by step makes it more understandable.
Definitely. But before we sign off, we always like to leave our listeners with something a bit more provocative. A thought experiment that pushes the boundaries of what we just discussed.
Okay, let's take this idea of financial engineering to its absolute theoretical limit. We've established that STRC stability ultimately relies on two things: the massive underlying pool of Bitcoin and Strategy Inc.'s continued solvency and access to capital markets to fund those dividends via the circular model.
Right. The solvency and market access are the key risks we identified for the dividend stream. So what if you could somehow eliminate that risk?
Imagine this. What if Strategy Inc. were to carve out, say, 50,000 Bitcoin and lock them into a permanent, legally distinct, ring-fenced strategic reserve fund, untouchable for other corporate purposes?
Okay, a dedicated reserve. Then what?
And then, using that massive, segregated crypto asset pool as a form of ultimate backing, Strategy Inc. somehow manages to secure a perpetual pledge, a guarantee from a major sovereign entity, let's say, hypothetically, the U.S. government, a pledge to perpetually cover the annual STRC dividend payments, that $640 million liability.
Whoa. So you replace the market risk of the circular funding model with the full faith and credit of a government, guaranteeing just that specific fixed annual payment stream.
Exactly. In that admittedly far-fetched hypothetical scenario, would the structure have effectively transformed STRC into something akin to a perpetual government security?
Like a super long-term T-bill almost. But instead of yielding the typical low treasury rate, it's offering that structurally guaranteed 10.5% or whatever the rate is, super yield, backed by both a government pledge and a massive segregated Bitcoin reserve.
It's a wild thought, right? Could the stability of the state be formally combined with the volatility of digital assets through financial engineering to create an entirely new class of ultra-secure, high-yield instrument? What are the ultimate limits here?
That is definitely something to mull over. The highest form of financial alchemy, maybe. A great question for everyone to think about.
Pushing the boundaries.
Okay, and speaking of financial engineering, let's bring it right back home to the financial engineering of our own little show here, our growth.
Right. We talked earlier about wanting to visualize all this complex analysis, the waterfall, the cost basis adjustments in video format.
Yeah, making it much more accessible.
And that goal, turning these deep dives into high-quality videos, is entirely dependent on us reaching that 1,000 subscriber target so we can get the funding for the right tools, specifically that Mosaic AI video editor we mentioned.
We really need your help to finance this technical upgrade for the show.
That tool, Mosaic AI, it just looks incredible for this kind of content. You feed it the link to this audio deep dive on YouTube, and it can automatically generate relevant, beautiful AI, B-roll footage, graphics, animations. It automates so much of the complex creative process.
It would let us make these numbers and structures immediately visual, much easier to grasp and share. We really want to bring that video dimension to you.
But we can only make that happen with your support.
Okay.
Seriously. So if you've listened this far, if you found this valuable, and if you haven't subscribed yet, please just take 2 seconds right now.
Hit that subscribe button, spread the word. Share this deep dive with colleagues, friends, anyone in your network who geek out on this stuff. Help us get the tools we need to keep making this content and make it even better with video.
Your subscription truly is the structural foundation that lets us keep doing these deep dives.
We really appreciate it. Until next time, keep searching.